So you have enough money for your down payment on your property, but you've been told you do not have enough money to cover all of the closing costs that come along with your purchase. And on top of that, the seller of the property you're interested in is unwilling and unable to cover those closing costs. So what do? Well, in this video, I'm gonna show you how you can get your lender to pay your closing costs for you. I'm Brand the Mortgage Man, and I've been helping home buyers like yourself for over 20 years with over 10,000 loans I've originated in that period of time. And today, I'm here to help you. So let me show you exactly how you can get a lender like me to pay for your closing costs. So I'm gonna give you a real life example of when this would be needed. So we're dealing with a client right now who was actually turned down by another big lender. The reason they were turned down is because they were trying to qualify for a bond program that gives them $10,000 toward their purchase that they would have to repay. Now, this borrower has a little bit of a unique situation when it comes to their employment history. With those unique situations, you can oftentimes find ways to get that to work with the underwriter at the lender, which would be us. However, there's a separate entity that has to approve that bond. In this case, it's the state of Florida, and it's the backer of that bond program through the state of Florida. They were unwilling to agree to allow for this unique employment history for the bond program. So this borrower was actually left with not enough money to cover the closing costs and the down payment on their home. In steps my team and I. So what we did in her case is what I'm gonna show you. She was trying to get an FHA mortgage with the bond program. So FHA, we know, I'm gonna put this here for you, just as a reminder, the down payment on an FHA loan is 3.5%, which is what she was doing. She was previously trying to get that bond program, which was covering this 3.5%. But she has the 3.5% in her own funds. That's the most important part. In this case, her 3.5% was just under $8,000. So we're gonna call it $8,000. That's how much money she has to her name to use for this home purchase. But on top of this $8,000, she still has her closing costs. And the closing costs on her purchase are $12,000. Now, if you've watched my videos on closing costs, where I broke it down in detail, you'd understand where this number comes from. If you haven't watched that video, I highly recommend you do if you're going through the home buying process or preparing to go through the home buying process. So she has the $8,000, she needs $12,000. So in total, she actually needs $20,000. Well, how do you get to $20,000 if you only have $8,000 and you can no longer get the bond program in this case that she was trying to obtain? Well, this is coming from two different places. So one, the $8,000 of this is covered by her. So we subtract $8,000 and it leaves us with the $12,000, which are the closing costs. Where does this $12,000 come from? Well, I mentioned that you can get the lender to pay for those closing costs. So in her case, we're talking about a loan amount that she's actually borrowing right around $300,000. So we're gonna say $300,000 loan amount. This $12,000 represents what? If we divide into the 300,000, we're talking 4%. So 4% of 300,000 is the $12,000 that she needs. So where is this 4% gonna come from? So in this case, we were able to look at the appraisal on the property and it actually came in above the agreed upon purchase price. So what we did to try to cover some of this gap, because a portion needs to come from somewhere and the other portion is coming from us as the lender in this case, how do we get to the full $12,000? Well, in this case, the property original purchase price was $295,000. However, the appraised value of the property was $300,000. Now, I'm often asked on a purchase, is it possible for me to finance the closing costs? And the answer to that question is yes and no. The only time it's possible to finance those closing costs, but potentially or in some way finance those closing costs, are in these situations. So the property overappraised, we lend based on the appraised value. The seller agreed to $295,000. This was the original purchase price. What we did was we had them raise the purchase price to $300,000 to match this appraised value. That's a $5,000 difference. From that new number, we took $5,000 as a seller credit, right? The seller is still getting their $295,000 that they were expecting because $300,000 minus $5,000 equals $295,000. However, what this allowed is for our borrower to obtain $5,000 that they initially were not getting. And they're rolling it into the loan essentially because now our loan is based on a $300,000 purchase price instead of a $295,000 purchase price, right? So that's essentially financing the additional $5,000. So now we take this $5,000 and we're going to subtract it from the 12, leaving us with $7,000. Now, where does this $7,000 come from? Well, this $7,000 is coming from us as the lender. But how is it possible that we as a lender are able to give someone $7,000? Well, here's how that works, and here's how it should work with just about any lender. So let's just say that this borrower qualified for an interest rate, and it's actually a fact, she did, of 6.5%. And at 6.5%, there's no lender credit, right? So we say zero lender credit. However, at 6.75%, there is a lender credit. And the lender credit that we're able to give at 6% is actually the $7,000. So how are we able to give $7,000? Well, this is pretty simple. Lenders get paid for doing your loan. They make their money on the interest rate. Some lenders make more than others. So a lender is going to have a set margin or a set amount that they're expected to make on every single loan, which is a percentage of that loan. Let's call that number 2%, right? That's pretty fair in any market. So we're going to say the lender's goal is to make 2%. Now, they could be making this from the interest rate. They could be charging you discount points. You may have heard that term, right? To reach that number. However, let's just say this 2% is in the interest rate. Well, maybe a 6.5 is paying the 2%. However, a 6.75 in this case might be paying 4%, meaning it's paying 4% of whatever the loan amount is. So what happens is that extra 2%, just giving you the example, you have this extra 2% times 300,000 is $6,000, right? We were saying that we were trying to cover the gap of $7,000. So what we did for her, because this is the exact scenario, is we were able to get her the $6,000 from the interest rate just by going up by 0.25%, which is minimal in the monthly payments. And we were able to get her the additional $1,000 that she was still short by reducing our processing and underwriting fees. So lenders charge up front for processing and underwriting. Those are two real services that lenders do provide. However, I was willing to give up $1,000 of what we charge for those services in order to help cover that difference. So between the slightly higher interest rate, the seller credit that we obtained through raising the purchase price to the appraised value, and waiving a portion of our processing and underwriting fee, we're able to close the gap on the amount of money that was needed by this borrower without having to utilize the bond program that she was no longer eligible for. On top of all that, as great as it is, she's getting into this home for literally just the down payment. And if you think about this, that down payment money, it's still her money, whether it's equity in the property or whether it's cash sitting in her bank account. All she did was move it from her checking account into this equity, because if she ever sells the property, that money is still there, right? It wasn't actual cost. What's great for her is we're covering all of the true cost between the credit from the seller and the credit from us as a lender. So she's getting into this property for just the down payment. Had she qualified for that bond program, and there's nothing wrong with the bond program, but if there were a negative that I would point out with the bond program, is that money actually does have to be repaid. So it's not free money. So when she would sell the property or refinance the property in the future, she would have had to pay back that $10,000 that she received from the bond program. With this scenario, she no longer has to do that. So, long story short, make sure that you speak to your lender about options where they can actually assist with covering your closing costs with little tricks like this. And if you want more information about mortgages and real estate, make sure to subscribe to my channel for more information just like what you saw in this video. And leave a comment below if you have a question about your own scenario, because I do reply to 100% of the comments left on my videos.